$80 billion wiped from the crypto market in 72 hours. Bitcoin at 66,000. Ethereum broke below 2,000 for the first time since mid 2024. XRP is down 65% from its high. Solana is down 72%. And every other YouTube channel right now is going to tell you this is the end. This video you're watching right now is not that. My name is George, and this is the Bull Runners channel. This is not financial advice. Please do your own research. I want to actually show you exactly what caused this crash, because there are very specific reasons, in my opinion, and none of them have anything to do with crypto being broken. Then I want to show you the signals that suggest the worst of this might already be behind us. So if you're watching this and you're feeling a knot in your stomach, drop 3 fire emojis in the comments right now. I want to see them, okay? And stay until the end of the video, because I've got something for you that's pretty special in my opinion. Now, in the market's crash, it's rarely one thing. It's usually a pileup, 2 or 3 things colliding at the worst possible moment. It's exactly what happened this week. And once you understand each piece, the whole picture makes a lot of sense. On Friday, the 27th of March, $14.16 billion worth of Bitcoin options contracts expired on DERIBIT. This is the world's largest crypto derivatives exchange. That's nearly 40% of all open interest on the platform settling in a single day. The largest quarterly expiry of the year. Now, if you're not familiar with options, here's a simple version. An options contract is a bet on where the price will be on a specific day. When a huge amounts of these contracts expire at once, it creates an enormous mechanical selling pressure. As traders unwind their positions, it's a bit like a dam releasing. The pressure builds up, and then suddenly everything releases at once. The critical number here is something called the max pain price. And on Friday, that was actually set at $75,000. That's the level where the most contracts expire worthless. All right, where the people who sold the options make the most money. And here's where it gets really interesting. The man running the world's biggest crypto derivatives exchange told you this was coming. The gravitational pull dragged the price down toward max pain. Over 122,000 traders were liquidated. Total losses hit $451 million in 24 hours. But here's the key thing to understand about this. The wait is now gone. The expiry happened. The board is reset. The mechanical selling pressure that was suppressing the market through whole of last week no longer exists. The second trigger I'm going to talk about is the double choke point. Okay, this is geopolitical, and this is one that is genuinely serious. Iran's Revolutionary Guard declared this week it will block Strait of Hormuz traffic tied to the US and Israeli allies. The Strait of Hormuz handles roughly 20% of the world's daily oil supply. That's not a minor shipping lane. It's the main artery through which the Middle Eastern oil reaches global markets. Here's the analogy. Imagine the global oil supply as water flowing through a pipe. There are 2 taps on that pipe, the Strait of Hormuz at one end and the Bab al-Mandeb Strait at the other. Now, the Houthis have already been threatening Bab al-Mandeb. Now Iran is threatening the Hormuz. If both taps get closed at the same time, the flow breaks from end to end. Oil went above $100 a barrel on the back of this news. When oil spikes, inflation fears spike. When inflation fears spike, what happens? The expectation of interest rate cuts, gets pushed further away. And when the rate cuts and gets pushed further away, risk assets, including crypto, sell off. This is not a crypto story. It's an oil story that has affected crypto. Now, the third trigger is the most boring to explain, but it's the most important structurally. Treasury yields. The US 10-year Treasury yield is sitting around 4.5% right now. When yields go up, what does that mean? It means the guaranteed return you can get from holding US government bonds goes up. And when that happens, money that was sitting in risk assets, stocks, crypto, anything with volatility starts looking at those guaranteed returns and moving over. Think of it like this. Imagine you have 2 options for your money. Option A, a guaranteed 4.5% return with 0 risk. Option B, an asset that could double or halve in value. When option A gets more attractive, people shift money. And when enough people shift at the same time, prices fall. 3 triggers, 1 week, none of them caused by anything fundamentally wrong with crypto. The plumbing is fine. The macro hit the pipes. Okay, so let's go asset by asset. I want to be straight with you about where each one actually is because I think a lot of content right now is either catastrophizing or being falsely reassuring. Neither is unusual. Bitcoin is at $66,194 as I'm recording this right now. That's 47% below its all-time high and $126,080 set in October last year. The key levels to watch. $60,000 is the major support flow. That's where the buyers stepped in aggressively in February and it held. On the upside, 72 to 75,000 is the resistance zone. A clean close above that with volume is the technical signal most analysts are watching for. The interesting structural detail, exchange reserves, the amount of Bitcoin sitting on exchanges ready to be sold, just hit a 6-year low of 2.31 million Bitcoin. Less Bitcoin on exchanges means less potential selling pressure. The long-term holders are just not selling now. When we speak about Ethereum, this actually broke below $2,000 the first time since mid-2024. It's down 60% since August 2025. In August 2025, there was a high of 4,953. That's a significant number, and I'm not going to pretend it isn't painful for ETH holders. I'm one myself. The $2,000 level has psychological significance. It's a round number that retail treats as a reference point, but structurally, the Ethereum network is running normally. Gas fees are low, layer 2 activity is healthy, the protocol has not broken, the price has. Our favorite on the channel, XRP, is at $1.33. That's down 65% from its July 2025 cycle high of $3.65. And here's the thing that makes XRP the most frustrating story, but also, in my opinion, the most exciting story in crypto, is in this market right now, the last 12 months, Ripple has had more fundamental wins than almost any other project in crypto. The SEC classified XRP as a digital commodity in March. 7 US spot XRP ETFs launched between September and December last year. And we spoke about these on the channel. Pulling in $1.4 billion, Ripple launched a full institutional services in Brazil. A $1 billion XRP treasury company filed for NASDAQ. Win after win after win, and we spoke about it every single video. And the price is down. It's down 65%. I'll explain exactly why in part 3, so stay tuned, because there is a very specific reason, in my opinion, why I think this is happening, for the disconnect in XRP and the price. And understanding it actually tells you something important about when XRP actually might move. Talking about Solana, this is the hardest hit of the majors, down 72% from its cycle high. And unlike Bitcoin and Ethereum, where the on-chain fundamentals are holding up pretty well, Solana's network metrics have softened. Transactions down 3.2%. Active addresses down 11% over the past month. And that's worth watching closely. Solana had an extraordinary run through 2024 and 2025. The Append Glow upgrade is still in the pipeline, but right now it's feeling the double pain of macro headwinds and some slowing network activity. Right, this is a great time to stop for a second, guys. I'm in the back office at Bull Runners and I can literally see the numbers. The majority of people watching this video right now are not subscribed. The majority of people that watch these videos don't end up subscribing. So if you want to see more of this type of content, hit that subscribe button right now. Take a moment to do that and drop a like. It actually signals the algorithm to show you more of these videos, so you don't have to just search them. They'll pop up on your feed. Thank you so much if you've just done that, okay? It does keep us motivated to do this. And also apply for a portfolio strategy call by clicking the first link in the description below. If you want to learn how to earn passive income from your crypto without giving up custody of your private keys, spending hours staring at complex charts, or ultimately risking your long-term bag to implement loss, we have the top crypto researchers in the world available to help answer any questions you have. The link is literally below this video, guys. And YouTube also just dropped a hype feature, so if you could do one more thing for me, you can actually hype this video, which pushes it to people who need to hear this. If you've got one spare, send it. All right, let's get straight back in to what I was speaking about. Now, I'm going to speak more about the XRP problem that I mentioned earlier. So let me explain the paradox behind this, because I think it's actually one of the most useful things you can understand about how the crypto markets work. And most people don't get it. XRP has a better fundamental news than almost any other major asset in the last 12 months, and it's still down 65%. How? The answer is correlation. XRP tracks Bitcoin with a 0.80 correlation. What does that mean in plain language? For every single move Bitcoin makes, XRP makes a similar move, except about 1.8 times bigger in the both directions. So Bitcoin goes up 10%. What does that mean for XRP? It also goes up, but 18%. Bitcoin goes down 10%. This is where it gets scary, because XRP will go down 18%. Think of it like a team sport. XRP might be the best player in the field, best fundamentals, best regulatory news, best institutional partnerships, but if the team is losing, if Bitcoin is in a downtrend, that player is going to lose the game. Individual performance doesn't override the team result. So what actually moves XRP independently? Two things. Number one is Bitcoin, breaking above the $75,000 resistance level and holding it. Once Bitcoin is in confirmed uptrend, XRP doesn't just follow, it amplifies. That 1.8 multiplier works both ways. The second thing is legislative clarity. The Clarity Act specifically The SEC's March 17th ruling that XRP is a digital commodity is significant, but it's an interpretive release, not federal law. A future administration could reinterpret it. Banks and major asset managers need legislation before they commit capital at institutional scale. There's also a supply side issue worth understanding. Since XRP peaked at 365 in July last year, large holders with the industry calls whales have been selling steadily, and an estimated $6 billion in XRP has been sold by large holders since that peak. Roughly 3.8 billion tokens have flowed onto Binance since January this year alone. That isn't panic selling. It's profit taken by the people who got in early. Okay, if you got in early, well done. And it will eventually run its course. But right now, it's adding consistent sell-side pressure on top of the macro headwinds. When Bitcoin breaks, when the Clarity Act passes, when the whale distribution winds down, that's when XRP's fundamentals finally get to speak through the price. All right, let's talk about what actually points towards a recovery, because there are three signals right now that I think mainstream narrative is completely missing. And I want to really emphasize that on this channel. The total amount of USDT, USDC, and other dollar-pegged assets sitting in the crypto ecosystem is at a record $316 billion right now. Here's what that number tells you. That capital hasn't left. It hasn't gone back to the bank. It is sitting in crypto ecosystem in stable coins, waiting for the right moment to rotate back into Bitcoin, Ethereum, XRP, Solana. The analogy is simple. Stable coins are like cash sitting on the sidelines at an auction. The auction hasn't started yet, but when it does, that cash moves fast. To put it in historical context, during the 2020 to 2021 bull cycle, I'm sure some of you really enjoyed that, stablecoin supply grew from around 20 billion to 120 billion. That growth came shortly before Bitcoin went through roughly 10,000 to 69,000. We're now at 316 billion. The pool of available capital is categorically larger than anything we've ever seen before. The $14 billion options expiry that caused so much of last week's mechanical selling pressure is done, it's settled, it's gone. Markets now move on pure supply and demand. No more delta hedging by market makers. No more artificial gravitational pull towards the max pain price. The weight that we're sitting on top of this market has actually been lifted. So VanEck's digital assets team put out a note in mid-March that I found generally interesting. They tracked what's happening historically. When the options put-to-call ratio, a measure of how defensive the market is, reached the levels it is at now, the data goes back to 2019, and these extremes of defensiveness, Bitcoin has returned an average of plus 13.2% over the following 90 days. That's the number one ranked outcome across all decile groupings. Institutions still haven't blinked. And this is the one that I keep coming back to through everything that's happened this quarter. The Iran conflict, the treasury yield spike, the options expiry, the 50% drawdown from the all-time high. US spot Bitcoin ETFs have maintained $18.7 billion in net flows in Q1 2026 alone. Cumulative lifetime inflows across all US Bitcoin ETFs have now exceeded $65 billion. The institutions that built positions in 2024 when the ETFs launched, they didn't flinch, and there's a reason for that. Now, there is a bear case, and I want to be honest with you about it because I think good content acknowledges the other side. The most persistent bear voice right now is Bloomberg Intelligence Mike McGlone. And he's been saying this consistently for months on camera. McGlone is credible. He's been at Bloomberg Intelligence for a long time, and he's called the 2022 bear market correctly. So I'm not going to dismiss him. But here's where I push back. McGlone's bear case is essentially that Bitcoin behaves like a risk asset, that the US stock market and liquidity tighten. Bitcoin follows everything else down. And historically, it's been true. What changed is what we discussed in our last video, the ETF buyer base, $65 billion of institutional capital that has proven it doesn't behave like retail. It didn't sell the 50% dip, it bought it. And if there is a counter argument, Matti Greenspan, the founder of quantum economics, who built his career at eToro, had a very specific response to McGlone's $10,000 prediction. A nuclear war and the internet to stop working. I think that's probably right. The structural flaw on this market is fundamentally different to any previous cycle because of the ETF institutional layer. That doesn't mean we can't go lower in the short term. That means we absolutely can. But McGlone's scenarios requires a reversal of everything that's been built in this space since 2024. What are smart holders doing right now then? This is what people keep asking. So let me bring it home, because I think the most important thing in a market like this isn't analysis. It's how you behave when the analysis has been done. Three things, that's it. One, check your thesis, not your portfolio. If you bought Bitcoin because you believed in the institutional adoption story or the tokenization story, has any of that actually changed this week? The NYSE announced a 24/7 tokenized securities platform 8 days ago. ETF inflows are positive on the year despite a 50% drawdown. The Clarity Act is moving through Congress. The macro hit the market. The thesis didn't break. If your thesis is intact, your position doesn't need to change. The second thing, understand what the data is actually saying. $316 billion in stablecoins sitting ready to rotate. Exchange reserves at 6-year low. Options pressure cleared. VanEck data showing that historically, these moments of extreme put demand have produced the strongest subsequent 90-day returns. That's not hopium. That's pattern recognition from real data. 3, the people who build real wealth in crypto are not the ones who react to every headline. They're the ones who built a framework before the volatility hit. They know their position sizes. They understand yield strategies, and they don't require selling their long-term bags. They have a plan for when things drop, not a panic and decision made at 3 o'clock in the morning, 4 o'clock in the morning, 5 a.m. in the morning. And then there's the final word on Wall Street from where this is actually going, because while the fear is at its loudest, Bernstein, one of the most respected research houses on Wall Street, made a call this week I think deserves to be heard. The weakest Bitcoin bear case in its history. That's Wall Street saying every crash driver is external, the structure is intact, and they're keeping their $150,000 year-end target. I'm not saying that's guaranteed. Nobody knows where the price is going to go in the next week or the next month. But when Bernstein is calling the bottom and keeping a 6-figure year-end target in the middle of a maximum fear, I think that's worth paying attention to. Now, let me put this all together one more time. The crash this week had 3 causes. A $14 billion options expiry creating mechanical selling pressure, now gone. Iran threatening to close a second oil checkpoint, sending oil above $100 and triggering risk off across all markets, and rising treasury yields at a 4.5% pulling capital away from risk assets. None of those are crypto native problems. The infrastructure didn't break. The institutions didn't leave. Thesis, especially mine, didn't change. Bitcoin is at 66,000, down 47% from its all-time high. The support floor is at 60,000. Exchange reserves are at a 6-year low. $316 billion in stablecoins is sitting ready to rotate. The options pressure has cleared, and Bernstein is calling the bottom. XRP has had every fundamental win possible and is still down 65% because it is tethered to Bitcoin with a 0.80 correlation. The catalyst that changed that, Bitcoin above 75,000 and the Clarity Act through the Senate Banking Committee, expected in April. The bear Caesars exist. Nope, the bear case exists. McGlone could be right, but it requires a reversal of $65 billion of institutional conviction. And that institutional layer has already proven it doesn't panic sell. The market is not broken, the macro hit it. There's a difference. If this has helped you understand what's actually going on, drop a comment and subscribe and share it with someone who needs to hear it. We just broke down in this video the 3 triggers that caused $80 billion to get wiped from the market in 72 hours. The options mechanics, the oil choke point, the treasury yields. And here's what I want to leave you with. If this is the most important part of the video, I hope it is. Understanding why a crash happened is one thing. But knowing what to do with your portfolio before the next one, that's something else entirely. That's a different league. And most people watching this video are going to nod along, feel a bit better. Maybe you got some value from this, and then go straight back to refreshing their chart. And I get it. The price is down. It's stressful. We're all stressed. The temptation to watch is overwhelming. But the people who build real wealth in the cycles like this are not watching the charts. I promise you. I see them every day. They're earning yield on their crypto through the drawdown. They had position sizes that let them sleep at night instead of panic selling at 3 in the morning. They had a diversification strategy built on where institutional money was going, not where it already went. And that's exactly what we built inside Altcoin Pro. We work with you on a one-on-one over a 5-month period. We show you how to track institutional movements, build allocation strategies based on multi-year thesis, and execute without emotion, whether the market is crashing, squeezing, grinding sideways for months, day-to-day trades, swing trading, long-term macro positioning, and passive income on your idle crypto using the same protocols the institutionals use. We have a small number of spots open right now, and if you try to book a call with one of our expert coaches using the link down below and there's no availability, don't worry, just check back in 24 to 48 hours. We actually keep the call availability very low deliberately to keep high quality. So if you're tired of being reactive in the markets like this one, watch the training video in the description and book that call in. Bernstein just called the Bitcoin bottom. Stablecoin dry powder is at a record $316 billion. The option pressure is cleared. Phase 2 is coming. The question is, are you ready for it? As always, I'll see you at the top.